Hi friends, do subscribe our channel ONS Study Circle and don't forget to hit the bell icon so that you can get the latest updates from our channel.
Hello friends, this is Vikas Mani and I welcome you all on this channel ONS Study Circle. Friends, we are in the series of ratio analysis and today in this video we are going to discuss some ratios of solvency. That means we are going to talk about solvency ratios, some of its part. Majorly we are going to talk about three ratios: total assets to debt ratio, debt equity ratio and proprietary ratio. But before we even start about the ratio, let us understand the basic concept how capital in business actually is being invested. We need to understand that as well, so that while we talk about ratios thereafter, it would become so easy for us to understand. So let's start it. How capital is being invested in a business? There are various ways. The shareholder itself can invest in business. We can take a loan. So there is a total structure and we call it as capital employed. How much capital we employed in a business? What are the ways? There are several ways. First of all, when we talk about shares, there are majorly two types of shares: equity share and preference share. Let us segregate it. Equity share plus their reserves, because equity shares holds a major risk in the business, so the reserves will belong to equity shareholders. We will talk about the equity share concepts and its mechanism in later videos, but let us understand equity share plus their reserves minus all fictitious assets. We will call it as equity fund. Equity fund means a particular fund belongs to only equity. Equity fund means a particular fund belongs only to equity. Equity fund, equity reserves, and then minus all fictitious assets. But once we add preference shares as well, it becomes equity. Equity means equity fund plus preference fund. But when we talk about equity fund, that means a particular fund belongs only to equity. So I hope the difference between equity fund and equity is clear now. Equity fund means a fund particularly belongs only to equity. There is no place for preference share. But once we add preference shares, it becomes equity. Okay, now we have equity. That means equity share plus preference shares. Once thereafter we add debentures and loans, it becomes total capital employed in a business. So this is the total capital structure in any business. The ways to enhance, there could be many more shares, many more ways to invest in a business by taking loans. Even loans do have various categories, but we are just talking about the common parallels. Equity fund means equity, their money, and once we talk about equity, that means equity plus preference, and once we add debenture, it becomes capital employed. So now let us discuss about some ratios. Debt equity ratio. Debt means total loan we have, and then equity. Equity stands for, because we have already discussed, equity stands for equity shareholder fund plus preference shareholder fund. And what are we going to do by using this ratio? Debt divided by equity, that means total shareholder fund. Total shareholder fund, total proprietary fund. Why do we call total proprietary fund total shareholder funds? Because preference shareholders are also shareholders. Preference shareholders are also a part of proprietary of a business. So we also call it as proprietary fund, shareholder fund. Equity, proprietary fund, shareholder funds are same. So we can use simultaneously. And debt means long-term debt. And when we talk about solvency ratio, we are going to analyze how much our business has a capacity to pay its loan, how much our assets are effective in order to run business as comparing to the total assets invested. So there are various ways either to check the efficiency, the capacity of our amount being a shareholder we have invested, as well as the capacity to pay the loan. There are various ratios for it, and we are going to cover three ratios in this video. The pending ratios we will cover on later videos. So Debt equity ratio, total debt divided by equity. Equity means equity shareholder plus preference shareholder, and total debt means long term debt plus debenture as well, because debenture are also another form of debt. So what are we going to do with this ratio? If we have the input, for example, if debt is higher than the money we have invested being a shareholder, it's a very bad sign. It's a sort of red sign. That means it denotes your loan is higher than your actual amount you have invested being a shareholder in a business. That means your capital is lesser than your loan. That means your business does have a high loan ratio. So it's a very bad sign. It's a sort of red point. We need to check it. So that's how we use this ratio to analyze it. Now the second ratio is total assets to debt ratio. Total assets to debt ratio. First of all, as its name says, total assets, whether it is short term or long term, that means whether it is current or fixed, we need to add it both. Total assets divided by debt. Debt means long term debenture plus all the long term liabilities. Total assets to debt. Total assets to debt. What actually it tells us? It tells us how much total assets we have and how our debt is performing. That means being a shareholder, if I want to know, are we using debt in order to generate more assets? If not, then why we are having debt? So first of all, I will check with debt equity ratio. If debt is higher, then why debt is higher? I will further check with total assets to debt ratio. Are we in an expansion mode of our business? If not, then why are we taking so much debt? Total assets to debt ratio tells us, for example, if total assets to debt ratio is higher or not higher, that means it tells us simply, for example, if total assets are way higher as compared to the debt, that means we are purchasing more and more assets using our debt. So it is fair sign. Maybe in a market there are many more opportunities to generate profit. So this could be the reason. Now the another ratio is proprietary ratio. Proprietors, equity and preference, both are owner of business. That means equity shareholder plus preference shareholder, their funds will be added and we will call it as proprietary fund, as same as we had it in equity. So equity, proprietary fund, shareholder funds, there is no difference, just a different name to pronounce it differently. Now proprietary fund to total assets. Proprietary fund divided by total assets. Total assets could be current assets or fixed assets. And what are we going to analyze using this ratio? We want to check how much being a shareholder over money is invested as compared to the total assets. For example, if our total fund is 40 and total assets is 100, that means 40% money we have invested in our business, and the rest part could have been anything, could be loan or any sort of business arrangements. But we will check it with profits. By investing 40%, how much profit are we getting? And if we just raise a little bit or if we just reduce it a little bit, then how profit will fluctuate. So it is related with the income statement and other profitability ratios as well. But the major concern about profitability ratio is we need to check how our business is generating profit to us. And in order to do that, we'll check the total assets capacity. Being a shareholder, how much our money is being stuck in total assets. So that's how we use this ratio. And I hope, friends, the concepts about capital employed, which is the most important to understand, is now clear. Let me summarize once again the concept. Capital employed. Capital employed consists three parts: equity, equity fund, and debentures or maybe loan. So equity fund denotes only fund relates to equity. There is no space in this case for preference. Equity fund, reserve minus fictitious assets. But once we add preference share as well in this particular fund, it becomes equity. And apart from equity, we can also call it as proprietary fund, shareholder fund. And thereafter, once we add debenture or long-term loans, it becomes total capital employed. Total capital employed. The meaning of total capital employed is how much capital is invested in a business. But there is a confusion. Being a businessman or being a shareholder, for example, if I have invested 40 lakh in my company, for me, total capital employed is 40 lakh. But for business, if we have a loan of 60 lakh, the total capital employed would be 40 lakh plus 60 lakh, 1 crore. So this was the concept about capital employed, and we have already discussed with some ratios of solvency. And we are going to cover many more ratios, friends. So stay tuned, and I really appreciate your love and support. Stay tuned. See you on next video. Till then, goodbye and take care.